Hello and welcome to the World Battery Metals and Mining News for the 17th of September, 2024.
Zijin vows to keep investing in Canadian mining despite crackdown. Zijin Mining Group, China's top mining firm, remains undeterred by Canada's attempts to limit foreign influence within its mining sector, particularly targeting Chinese state-owned companies. Despite Prime Minister Justin Trudeau's government enforcing restrictions meant to counter China's grip on the critical minerals supply chain, Zijin remains intent on investing in Canadian junior exploration firms. Zijin's persistence underscores its belief in the collaborative potential with Canadian mining entities, even if it means navigating regulatory hurdles. A prime example being its unsuccessful bid for a stake in Solaris Resources due to prolonged scrutiny. As Canadian juniors seek much-needed capital, often unavailable domestically, Zijin's investments play a crucial role, especially given the surge in demand for critical metals essential for electric vehicles and renewable tech. Shen, Zijin's vice president, insists market-driven, non-political transactions yield the best results for resource development, reflecting broader frustrations with Trudeau's policies amongst industry peers. U.S. Steel CEO confident Nippon Steel deal will close on its merits. U.S. Steel CEO David Burritt remains confident that Nippon Steel's $14.9 billion bid for his company will succeed, despite political and national security hurdles. Speaking at the Detroit Economic Club, he emphasized faith in the rigorous review process led by the Committee on Foreign Investment in the United States, CFI-US. This comes even after a CFI-US letter pointed to potential national security risks linked to the steel supply chain. The companies have responded, arguing the deal would enhance security by leveraging an allied nation's investment. Both political heavyweights, Kamala Harris and Donald Trump, are opposed to the deal, each asserting the need to keep U.S. steel American-owned. The matter has gained significant attention ahead of the tight November election, with business groups expressing concerns over political interference. The decision on the acquisition might be deferred until post-election, pending an extension of the CFI-US review beyond the September 23 deadline. Burritt did not disclose if an extension was granted, while the United Steelworkers Union firmly demanded the deal's rejection, citing national defense concerns. Brazil confirms potential $18 billion deal with miners involved in deadly dam disaster. The Brazilian government is in negotiations with Vale, BHP, and their joint venture Samarco regarding an $18 billion settlement for the catastrophic 2015 dam collapse that led to widespread devastation. The accident resulted in 19 deaths and significant environmental damage and left many homeless from the toxic tailings spill into the Doce River. Energy and Mining Minister Alexandre Silveira confirmed the ongoing talks, which also involve an additional 30 billion reais in direct remediation efforts by the companies, such as removing toxic waste. While the miners have already disbursed around 37 billion reais for compensation and remediation, a previous proposal offering 82 billion reais in new funds and 21 billion reais in repairs wasn't fully accepted. Vale is confident about finalizing a deal by October, and BHP and Samarco echoed their optimism. This debacle highlights the need for responsible mining practices to prevent such disasters and ensure accountability when things go wrong. Barrick projects 30% growth in gold equivalent production by 2030. Barrick Gold's ambitious organic growth strategy is poised to boost gold equivalent production by 30% by decade's end, leveraging its robust asset base without the need for costly acquisitions. CEO Mark Bristow highlighted the integration of Barrick and Randgold assets, emphasizing the success of unlocking value from its portfolio. Homegrown projects in Nevada, such as Gold Rush and 4 Mile, are set to become major contributors, with the Leeville project poised to significantly expand Carlin's reserves. Remarkably, Barrick has not only replenished but upgraded its gold reserves in the past 5 years. In tandem with its gold ventures, Barrick is making strategic moves in copper, with significant projects like the Reko Diq in Pakistan and the Lumwana Super Pit in Zambia on the horizon, the latter aiming to double production and have a lifespan exceeding 30 years. This dual focus on gold and copper strategically positions Barrick to capitalize on future market demands and secure sustainable growth. Zambia Mines lobby calls on government to halt reforms. Zambia's Chamber of Mines has raised the alarm over proposed legislative reforms, warning they could jeopardize investors' rights and hinder the country's goal to increase copper production fourfold. The industry body, encompassing giants like First Quantum Minerals and Barrick Gold, criticized President Hakainde Hichilema's government for its lack of meaningful consultation with mining firms. Although Hichilema initially mended fences with the industry, the new draft law and plans for increased state control, such as a state-owned company grabbing 30% of future critical mineral mines at no cost, risk reversing this progress. With copper being vital for 70% of Zambia's export earnings, the chamber argues that such heavy-handed measures will drive away potential investors crucial for ramping up production to 3 million tons by early next decade. Additionally, proposed governance changes that would give broad discretionary power to regulators might invite corruption, further destabilizing investor confidence. Bank of America forecasts copper price above $10,000, iron ore price below $80 by 2025. Bank of America analysts predict copper prices to surge above $10,000 per ton by 2025, driven by high demand, constrained supply, and increased investments in energy infrastructure. They point to potential Fed rate cuts, stabilizing manufacturing activity, aiding in maintaining the strong copper outlook. Challenges in mine supply and refining have already pushed copper prices up 6% in 2024. Conversely, iron ore prices are expected to drop below $80 per ton, influenced by declining demand, particularly in China's property sector. This sector has seen a significant decrease in consumption due to government crackdowns and a slowdown in housing construction. Negative steel mill margins have led to production cuts in China, and with Australia and Brazil boosting output, a supply glut is imminent. This glut, expected to hit 7.5% of total supply next year, suggests prices will need to fall significantly to either slow the addition of supply by large miners or push out higher-cost operations, particularly in China. BHP warns AI boom would worsen copper shortage. BHP, the world's largest mining company, has highlighted a significant concern over the rising global adoption of artificial intelligence, AI, not due to existential risks, but due to its energy-hungry nature, which could spur a dramatic increase in global copper demand. BHP predicts that copper demand will soar by 3.4 million tons annually by 2050, driven largely by the growth of data centers, which are projected to increase their copper usage significantly. Despite data centers becoming less copper-intensive, the transmission of electricity to these centers remains heavily dependent on copper. With a projected rise in global copper demand from 30.4 million tons in 2021 to 52.5 million tons annually by 2050, a significant supply shortfall looms on the horizon. This has led BHP to aggressively secure copper assets, including a major acquisition of Oz Minerals and a recent partnership with London Mining to acquire Philo Corp. These strategic moves aim to bolster BHP's stronghold in the lucrative copper market, essential in the increasingly electrified global economy. Evidently, copper's critical role in sustainable technologies outmatches the market's current supply capabilities, emphasizing the urgent need for more rapid development of new mining projects. Newmont on track to get at least $2 billion from asset sales. COO says Newmont Corp, the world's largest gold mining firm, is progressing well in its strategy to divest smaller mines and projects, anticipating at least $2 billion in proceeds. This action follows its acquisition of Newcrest Mining Limited and is part of a larger plan to concentrate on high-yield Tier 1 assets, which produce a minimum of 500,000 ounces of gold equivalent annually for at least a decade, while also increasing its copper investments. Recently, Newmont sold 2 Australian assets to Greatland Gold plc for up to $475 million and aims to finish the sale of other assets in Ghana, the US, and Canada by early 2025. The Akyem mine in Ghana is nearing sale completion, and due diligence is ongoing for other mines in North America. Once they trim the fat, Newmont will be better positioned to capitalize on its core, high-performing assets. Goldman says gold may dip if Fed opts for quarter-point cut. Gold could experience a slight dip if the Federal Reserve opts for a modest 25 basis point rate cut this week. But Goldman Sachs projects a subsequent rally towards a record high of $20,700 an ounce by early next year. Analysts argue that Western capital will flow back into gold ETFs as the Fed continues its easing cycle, a significant component that has been missing in the recent gold price surge. This year, gold has already performed remarkably well, driven by central bank purchases and a market eyeing the Fed's turn to monetary easing. Despite some tactical downside in the near term, ETF holdings are expected to gradually bolster gold prices. Notably, global ETF holdings had rebounded from their mid-May slump, but still remain significantly lower than their peak during the pandemic. As ETFs accumulate bullion, they effectively reduce the physical supply available in the market, further supporting price increases. Spot gold currently hovers near $2,585 an ounce, while silver, often trailing gold's movements, is on a 7-day winning streak.